You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So let's bring in Anurag Rana. He's a tech analyst for Bloomberg Intelligence. He's been following Apple stock for decades here. How important is today, Anurag? I feel like Apple doesn't have the AI juice in its stock. Is that something they care about?
No, they have to care about it because that's the most important thing in investors' mind right now. So there are a few things we already kind of know thanks to Mark Gurman is there's going to be most likely an announcement with OpenAI, some kind of joint agreement with them to use their technology into the new operating system. So I would say a lot of that is already built in. We all know that Apple doesn't have its own large language model as good as what's available with OpenAI or arguably with Google. But they can partner with these two companies. So that's the luxury Apple has, that it does not need to do everything in-house. And that's what we're going to look forward today is what's the strategy in terms of working with partners and then using that technology to fuel the operating system.
Will it justify the run up in the stock? How do you make the correlation between the news and what we're actually going to get and the actual move in Apple share price?
So Alex, one of the things I would say is for the past 1.5 to 2 years, there has been nothing but bad news coming for Apple. That has been an issue because iPhone growth has slowed down, mostly because of China. So I would say this is the first sliver of good news that has the potential to improve iPhone sales next year. It's not going to do anything this year. I mean, it's very difficult to model that out. But if the operating system has enough juice for people to figure out and say, I will go out and change my phone next year, I think that is the gas people are looking for, is whether that can go back and reignite sales growth.
Anurag, we were talking with Mark Gurman earlier this morning, and he kind of suggested that it can be taken as a little bit of an embarrassment by Apple that they do not have kind of their own AI capabilities in-house, that they need to partner with OpenAI. Do you think investors view it that way, or they're just like, we don't really care how you get it, just put it on the device?
Yeah, but personally, I don't care how you get it on the device. Same thing for search. What I really like about that, if their partner is, then they don't have to spend billions of dollars to do it in-house. If you look at the capex of Apple compared to some of the other companies, it's much smaller. And I'm okay with that because it helps out in my free cash flow. As long as they can partner with people, I'm absolutely fine with it.
Well, let's go to the idea. You can bring my daughter into this. So
oh boy.
I'm doing a lot of reading yesterday on Apple. I'm taking all my notes. I'm doing my homework. And I said, hey, Dylan, I was like, that Apple's going to have this thing tomorrow, and they're going to maybe unveil something that will help emojis, and you can get better emojis when you're typing text. And she's like, that is so cool. When are you going to get the new phone? And I think, Anurag, that's your point. Where people like my daughter are like, that's awesome, upgrade your phone now. Because I'm like, a few years. She's like, no, you got to get the phone because I need the emojis so I can send texts to my friends. That's basically what you're talking about. There's a huge install base. You do something that even is like semi-cool, and that's going to drive sales.
Yeah, I mean, that's the coolness factor. And frankly speaking, one of the things that really caught my attention is Mark Gurman reported that the new features would be available on iPhone 15 Pro and the newer one that's coming. I mean, that's a big deal because frankly speaking, if that's a very small portion of the total install base, even those early adopters, if they go out and rush to increase their, the refresh the phone in a much quicker way, that's going to help out Apple.
All right, so what else today should we be looking for, Anurag? I mean, is there going to be a new watch, a new anything, or is it just getting everybody to focus on AI?
Yeah, it's all going to be AI. And I think one of the things I really liked, what I have seen from Apple in the last 6 months is now they are all focused on this product. Because one of the things, again, Mark said that, they shut down the cards project, which has been around for, so many years, taking out massive amount of investments. And then you could say that they diverted that attention and not focused on AI completely. But right now, the entire company is focused on AI, embedding it every product, every operating system, every feature. And I think, one of the things we have heard even in China is consumers don't like that Apple's been behind in this particular one, and that has been a reason for them not to upgrade their phone. So I think Apple's taking this a lot more seriously. I think other tech companies are taking it a lot more seriously, who have been, I would say, taking their dominant position in their respective markets for granted over the last few years. And that's what I think OpenAI has done for the rest of the ecosystem also.
Anurag, what are the derivative plays from this when we're hearing the announcements from Apple? In your world of software, where should we be paying attention to?
I think, what we think is going to happen is over the next 1 to 2 years, every software company is going to embed more AI features into their core software product. Now, the question is, some of them will have the ability to upcharge for that, which means they will have a pro model or a premium model or a pro plus model where the average revenue per user can go up. This way, they don't have to go out and look for a brand new user to sell that software. They just have to convince the buyer that it is worth your while to upgrade that software into the one that has AI features. I think that is where bulk of the investments are going to in terms of the software industry. We think every major company will play a role in it. The ones that we have seen so far is stuff that's coming out from Microsoft, whether it's in the Office suite or the one that we like quite a bit is their coding software, where the software developers can actually do automated coding in a much faster way. I think that will have a massive upsell rate because the benefits of productivity are way too high over there.
All right, Anurag, 30 seconds. Question of the day. I have an iPhone 11. Do I upgrade now or wait?
This winter, when the next one comes in, which is the iPhone 16 or so, I think you will be very happy with that particular one.
iPhone, did it work? Like, can you run stuff?
Yeah.
But at some point, like, the apps just don't update and the software doesn't update, and like you have to turn it in.
Well, the big thing that what always prompts me to upgrade is the battery. When a battery starts, that's the message. All right, Anurag, thanks so much for joining us. Anurag Rana, he saved me a couple $dollars today. I'm not going to go out and buy a new iPhone. He's a senior technology analyst for Bloomberg Intelligence. Yeah, it's always the battery that kind of gets me.
The battery is rough, yeah. But I do my thing on like low battery all day. Like you don't do that.
No.
I do, yeah. Which is fine. It just means that instead of like staying up and connected for a long time, it just goes to sleep and then I just have to wake it up.
Really?
Yeah, but it lasts like a really long time.
I don't know anybody that does that. You're the first person that...
Doesn't this track for me, though? I don't know. I feel like this all makes some deep sense. Anyway, we're definitely watching Apple and looking forward to that announcement coming there. It has a really big run-up.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio, where we cover all the news in business and finance through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies in 130 industries worldwide. We also like to tap our guys over at Bloomberg Economics, amazing men and women who do the economic side of the entire world. David Powell is senior Euro-Area Economist for Bloomberg Economics, and he joins us now. David, BTP Bund spread, right? You have the France versus German 10-year spread, 55 basis points. We haven't seen that all year. You have a huge sell-off in the bond market in some of the main countries, even in Italy and Spain and in Portugal. Equities are getting hit. What do you make of what unfolded over the last 24 hours in France and the European Parliament?
Well, the far-right parties of Europe had very large gains in the European elections. These are the elections for the European Parliament, and that wasn't so much of a surprise in itself because polls were showing that was likely to happen. But the big surprise is what's happened in France is the reaction of the French President Emmanuel Macron to the outcome, and he announced a snap parliamentary elections. This won't affect his role as president because that's a separate election. But soon the French will be going to polls to be voting for new members of Parliament, and for our American listeners, that's similar to the members of the House of Representatives. And then the composition of that lower house may change, and in fact, polls suggest it will, more in favor of the party that just won such a large number of seats in the European Parliament.
So, David, in the European Parliament, what were some of the contributing factors to that strong performance by the far right?
Well, discontent with the way things are going. Of course, that's not unique to Europe. In America, a lot of voters have aired concerns about inflation, what that means for their spending power, and that has that's had a similar impact on the electorate in Europe, where people are upset about these high prices, the cost of living crisis, as they refer to it. But in addition to those developments in France, what they've also had recently is a change to the pension system in order to make it more affordable. So they've lifted the retirement age, and that was done by the French president, and it was not a popular move, as you can imagine. No one wants to be told that they have to work for longer in order to receive the same benefits, and that has been a source of support for this for the far right, which came out at the time opposing that. That's done. They've also come out opposing recent changes that are being discussed to the system of unemployment benefits. So there's now a debate about shortening the duration of unemployment benefits that the government is leading.
So what I find interesting, David, is the idea, and the more I read about it, the more it's like Macron's calling the far right bluff. And it's like, all right, you guys want those policies? Let's see how much you want those policies. What is your assessment as to how risky or not that strategy is and the effect it could have on the economy?
Well, some of the things that Macron has pushed through, like raising the retirement age and this debate about shortening the duration of employment benefits, obviously they're not popular, but they're necessary because France has a huge budget deficit. They're under a lot of pressure from the European Commission to reduce the size of it. Their debt is growing increasingly large, and these reforms will reduce the amount that the government is to pay out to pensioners and the unemployed, and they'll also boost the potential size of the economy. So it's kind of a win-win situation from an economic point of view. And even though these aren't popular, Macron is saying these are necessary steps in order to get the public finances in order. And the far right has been opposed to many of these moves, but they haven't proposed other solutions. So I think one of the things Macron's kind of doing here is saying, you like to be opposed to what I'm doing, but you're not putting forth any solutions yourself. And while you're in opposition, I guess that's your job to oppose the government. But let's see if you can put together some policies yourselves that would solve the problems instead of just complaining about what he has proposed as solutions.
David, can you give us a kind of an overview, just maybe how the economies of Europe are behaving, generally speaking? How are they in terms of growth? How are they in terms of inflation these days? What are the trends?
Well, Europe, like the United States, has had a inflation problem over the last couple of years, and in Europe it was made even worse by the extreme rise in commodity prices that resulted after Russia's invasion of Ukraine. So they have that inflation issue that's causing a cost of living crisis, and like the Federal Reserve, the European Central Bank, very drastically raised interest rates. Although unlike the United States, it had a major impact on the economy. So when we look back to 2023, I think the US economy grew something like 3%, and the Euro-Area economy did not grow at all. So there's been a much weaker economic performance as a result of the monetary tightening that's taken place.
Yes, we got the ECB that did cut rates. We don't know when the next one's going to be. And then we get this violent move in bond yields. And I appreciate, compare the sovereign debt crisis, it's like peanuts. But nonetheless, it's significant. At what point do bond yields affect everything else? Start to affect the economy? Like how high, how long do they have to stay for that to that to be implemented into the economy?
Yeah, I mean, higher financing costs for the government will have implications for the budget deficit, and implications for lots of other things. They're used as trademark interest rates in the economy in many places. However, as you said, these are small compared to what Europe dealt with in the past in terms of the Euro-Area debt crisis, and there's very unlikely to be any intervention from the ECB or anything like that, only because not only the movement's small, but during a period of high inflation, it's much more difficult for a central bank to intervene and to justify those moves than it is during a period of low inflation, because of course those interventions require just essentially printing money and using that money to buy those bonds. So we have had some movement in financial markets, but nothing that's screaming crisis, nothing that is screaming for the ECB to jump in and calm the situation.
All right, David, thank you so much. We appreciate that. David Powell, he's a senior Euro-Area Economist for Bloomberg Economics, joining us from London, the HQ for Bloomberg at Queen Victoria Street via that Zoom thing. So again, some big moves. As Alix was pointing out earlier, you have the euro off about 0.5%, 1.07 on the euro. You had the CAC fall off pretty substantially as well. The French index there off about 1.8% in terms of the stock market over there on the news of these snap elections.
So my question is then, do we learn anything about how other elections will be treated, like here in the U.S. or not? We know hedging doesn't work with these things,
Right.
as we learned, say, with Brexit. So it's going to be very interesting to see how long these moves actually last, which might give us some insight into when they have the elections in July, when the UK has their election in July, and when we have our election as well in November.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from the Interactive Broker Studio right here in headquarters in a beautiful Midtown Manhattan. Lisa was just giving you a check on the market. Also, Apple is down a touch, but it has a huge run-up since the end of April. NVIDIA is also down on that stock split. So we want to dig a little deeper here with Carol Pepper, founder and CEO of Pepper International. She joins us. Hey, Carol, do you want to buy Apple into today? Like, do you want to buy NVIDIA on the stock split?
Definitely buy NVIDIA on the stock split. I think that that's just a great sign, and NVIDIA is going to run right back up to over $1,000 a share.
Oh.
It is the engine right now, so I would definitely buy it and tuck it away and not look at it. Just leave it there. On fear days, it'll go down, so on a fear day, buy the stock.
So can we broaden that out, Carol, to say continue to buy some of these large cap growth stories across the board, or do we try to find some value out there?
No, I definitely feel like the value is large cap growth. Frankly, the leaders and the bigger stocks are getting bigger. They're in a position with all the cash on their balance sheet to be very muscular, to make the innovative deals, to make long-term investments where other companies are struggling. So in tech, at least, bigger is much better, and that's where you need to stay. And again, if you haven't fully filled out your tech allocation, it's something to take a hard look at. In general, I think growth will continue to outperform value. It has for over 10 years, and I don't see that trend ending anytime soon. Although it's still very prudent to own the entire S&P. The U.S. stock market is going to continue to outperform the rest of the world, certainly for the foreseeable future.
You know what you didn't mention, though, Carol? You didn't mention Apple. You're talking about large cap growth. We're talking about tech. I asked about Apple. You didn't talk about it. Makes me think that that's not in this thesis you have.
Well, I mean, the problem that I've always had with Apple is I feel like their product set is not that broad. I mean, okay, how many iPhones do people really need? Yes, you might upgrade the phone that you have, but are you really going to penetrate larger groups of new users? I'm not so sure about that. They're very expensive. We're in a high inflation market. I'm not as excited about Apple as I am about the other big tech companies like Amazon, certainly Microsoft, NVIDIA. We've got Google, even Facebook. You've got companies that are branching out into more areas of growth and expansion. And to me, Apple's fairly focused. The car thing was a mistake, and now they have to backtrack on that. I mean, they're still always going to be in the top 5. Don't get me wrong. That you can own them. I'm just not in love with them as, let's say, the leading story.
So are you in love with Microsoft and Amazon?
Yes, I've always been in love with Amazon since the very beginning, since they went public. Microsoft, I think, is very, very strong and will continue to be so. They have a much stronger focus on, I think, the corporate side of the business, and that's very smart because all of this AI innovation will start affecting corporate America, and Microsoft will most likely be one of the main delivery mechanisms because they're embedded in so many corporate systems and so many, Outlook systems and all the cloud storage that they're doing. I don't think that that's going to change.
So there was a great piece on Bloomberg that talked about how big tech's profit growth is going to slow. It's not going to go negative or anything. It's just going to slow from the kind of growth that we've seen. But that other areas like industrials, materials, and healthcare can see roughly 25% profit growth by the fourth quarter after a contraction of 20% or more in the first quarter. So I'm wondering, are you in love with stuff outside of tech and maybe in those sectors?
Well, I certainly think those sectors have room to move, which is fantastic. Certainly the GLP-1 story is going to continue and expand. We're going to see new drugs coming on, and that is a blockbuster category. But I also see that AI is doing tremendous work in things like cancer research and coming up with real cures in the health tech space. So I think healthcare will also always be a good core holding. But if you were to say what weight to put it on, I would overweight tech more than I would overweight healthcare, though, of course, to me, healthcare is a continued growth story because we have a lot of aging populations all over the world and they just simply need more healthcare. So yes, I mean, healthcare is always a good sector. Anything growthy is your friend. It doesn't mean the other sectors won't catch up eventually because a rising tide will lift all boats, especially when the rates start to go down. That's where I think you'll see value start to move some more. Because with value, you just have very much smaller margins to play with. So when you have high interest rates, you're more squeezed. And it's very hard to get out of that squeeze any particular way if you're not in a sector that's growing.
Hey, Carol, one of the themes coming out of the pandemic was onshoring and friendshoring. And a lot of folks are saying, take a look at Mexico. Is that a theme you like? And if so, how do you play that?
Yeah, absolutely. Well, as you guys know, I manage money for ultra wealthy families with over $100 million family offices, and they're very much looking at Mexico. There's a huge real estate play going on now between Mexico and the United States because many businesses are relocating their operations out of Asia to Mexico so that they can just drive goods right across the border into the US if they have to. So they're preparing for the next pandemic, frankly. Mexican, they had a huge election. The election went left. Of course, the wealthy families over there are quite nervous. But the incoming president has really pledged to not mess with the economy. And so far, so good. I don't think she will. Question becomes how much will the outgoing president pass his agenda before he leaves? But having said that, I think they're all very happy with the way the economy has been growing over there. So yes, Mexico will continue to grow. It's only actually just getting started. And there's a lot of activity in the real estate section. There's a lot of joint venturing between US and Mexican family offices going on. So keep your eye on Mexico. It's also a fantastic retirement destination for Americans who can't afford to stay here with the current retirement. I mean, you can live on your Social Security beautifully in Mexico, and you can't do that in the US in retirement. So there are already massive communities of retired Americans living across the border. And again, it's easy for them to get home if they prefer to have healthcare in the US. But it's a big trend. It's going to continue to grow.
Well, my best friend's pushing Costa Rica. Like, that's her thing. Like, they're going to move her family for a year. Anyway, so yes, that is a trend, Carol, for sure. Just a headline that's crossing here. I feel like this is for Paul because he'll get into it. BTP Bund spread, 10-year gap. Yep. Rises to 55 basis points, the highest in a year. And that's the difference between what the 10-year yield in France versus Germany is yielding. And since Germany tends to be looked at as the risk-free rate over in Europe, it's a sign of where the stress is. Before the sovereign debt crisis, France was really thought of as stable along with Germany, and the debt crisis kind of missed that, got rid of that a little bit, and there was more political risk over in France. Also, the equity market just getting crushed. Did we learn anything, Carol? Like, I know you're a U.S. person, but did we learn anything about what happened in the European Parliament and Macron's choice to call these elections for the lower house in relation to how we can trade and expect things here in the U.S. in November?
Oh, that's a really interesting question. Well, I would say in my opinion, the vote in the EU was a one-issue vote. It was an immigration vote because literally they're inundated. Almost every country has massive numbers of people arriving on their shores by boat because very close to get to Europe from other countries. So, the Europeans are sick of the immigration crisis. And I think his decision to call snap elections is worrisome because he may lose even more. And that's what people don't want to see. There is a fear of a return to a World War II kind of fascism in Europe in reaction to immigration. But having said that, the center parties still hold the majority. So I think for the EU itself, we're still set for this next cycle. But it's certainly a commentary on they're way more enthusiastic on climate change, and they're way more aggressive on trying to somehow stop all of this incoming immigration into your EU bloc. So I think those two factors are really driving that vote because average people are not happy with what's happening in Europe. So having said that, When you come to the United States, you're definitely seeing a number of voters very unhappy about immigration, and it's something that has to be dealt with in this country as well. We just have to have a better system that functions better. So it is a big election issue. Both sides are trying to grab it. I don't know what the outcome will be. It's a split decision right now in this country. But I do think here people are worried about fascism as well. Fascism is a scary rise throughout the developed world right now. And I do think in America, we have a real allergy to fascism. And when it comes to the voting polls, I don't think people are going to tolerate fascist talk in the United States. That's just my opinion.
All right, Carol, thank you so much for joining us. Carol Pepper, founder and CEO of Pepper International, joining us from New York City via Zoom here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, you know we love these big take stories here at Bloomberg News. That's where our reporters at Bloomberg News, they do some really awesome deep dives and on some really interesting stories. Today is no different. How about this one? Talent exit at Williams New York Fed. Stokes concern on its sway. Alix Harris joins us, Bloomberg short-term interest rate reporter here. So, Alix, thanks so much for joining us here in our studio. The New York Federal Reserve Bank, that's a big one. And so what's happening with our friends at the New York Fed? Because we need to pay attention to this.
Yeah, so what's kind of happened over the last couple of years is you've seen an exodus of basically senior management. These are people who have been with the bank for decades, just deciding to exit, either that they retire or that they, find another opportunity on Wall Street, or just really, but what's ultimately driving it is the environment is just not, they have found just not conducive, either that, there's been changes in the bank under, the leadership of John Williams that they have found, doesn't necessarily work for them anymore. And as a result, they're leaving. And what people are worried about is the so-called brain drain. It leaves a vacuum of people who are experienced at fighting crises. Because remember, a lot of these people have been there. They were there for the financial crisis. They were there for the repo market blow up. They were there in 2020. Like, they have crisis fighting experience. And so you're leaving a lot of that knowledge is leaving the bank, but then also just their ability and the question of are they ready for whatever's next, and that's what people are really concerned, is they're feeling like something is severely lacking under the leadership of John Williams.
First of all, I love that you wrote this, because Alix is usually the person that has those really nerdy repo market articles where you're like, I know this is important. I know I'm going to read it 3 times, and I'm still going to understand 20% of it, and I have to email Alix Harris. So thank you for writing an article that I understood right off the bat. What did they do about that then? I mean, is it as easy as like, hey, we're going to offer more work from home? Is it not that at all? Is it something very different?
I think it's very different. I think really what people are going to have to start looking at is taking a really serious look at the role of the New York Fed. For some people, they've said, look, Lori Logan got elevated out of the New York Fed to running the Dallas Fed, and she's taken a lot of that staff with her. She has this experience on the balance sheet. People really trust her. So now people are wondering, well, it doesn't necessarily have to be New York that carries out, the implementation of the Fed's policies when it comes to their balance sheet. Like, this could shift to Dallas. So people are starting to ask that question or pose that question. At the same time, though, people are pushing back and saying, no, this has to be in New York. We need to fix what is happening in New York. We need to retain talent in New York because the banks are here. And if something happens with the banking system, it's much easier to call everyone down to Liberty Street and say, hey, get in here. We got to figure this out, than trying to call people all the way down to Dallas and say, hey, we got to figure this out.
So historically, the New York Fed has been the branch that manages the Treasury's balance sheet, correct? Buying and selling bonds?
Well, the Fed's balance sheet. So their holdings are Treasuries and MBS and such. So
it's been done, and again, they have traders there and stuff that do this. I mean, this is where it happens in New York.
Well, and you have other, like Chicago still has, market analysis people. Like, they still have all these things coming out of the other banks, but it is primarily a function of the New York Fed. They're tasked with managing their Fed's portfolio. Roberto Perli is the SOMA manager, so he manages the Fed's securities portfolio. portfolio. So these things, and so the New York Fed really post-financial crisis has just taken on such a larger role. They've essentially become like a giant broker dealer, just given the size and the sheer size of their balance sheet. And that's, someone like Christopher Whalen is making the argument that you don't need an academic. You don't need an academic running the New York Fed. You need someone who's comfortable with operations, with the nuts and bolts, and can kind of see it from a more markets-oriented perspective than an academic one.
So how do they pitch that? Because who's going to give up a job at Goldman that pays a nice chunk of change? Actually, I have no idea how much the New York Fed does, but I have to assume it's less. But how do they do it?
It's like I think when I last look at the annual report from 2023, I think it's like a little over $500,000 that the president of the New York Fed makes. But I mean, look, Beth Hammack, who ran the Goldman Sachs funding arm, she's elevated. She's taking the role as the Cleveland Fed president. Lori Logan could always, people are speculating that she could come back to New York and run it. These are the kinds of people I think that they envision when they're thinking about the role and who can possibly, helm the New York Fed after John Williams decides to retire or step down.
Do we have a problem with John Williams? Are people placing the blame on these departures on John Williams and his style, or?
You know what? I think it's a bit of both. I think, when we spoke to people, the message was always, he is a brilliant macroeconomist, but just ill-suited for the role. I also think culturally, the other sense I got from people is that, culturally, it's very different than the San Francisco Fed, which is what he was running for 7 years before he came and took the role in New York. It's just very different. And, sometimes culturally people don't fit, and that's okay. And so that's something to also think about. And so I think it's a bit of both. I think it is somewhat of the culture and just sort of a not meshing.
Right.
They were just sort of ill-suited for each other.
All right, we'll keep an eye on that. Yeah.
Good stuff.
Yeah, Alix Harris, thank you so much. We appreciate it. Alix Harris, she's a short-term interest rate reporter working on the Big Take story here today. Talent exit at Williams, New York. Stokes concern on its sway in the marketplace about the New York Federal Reserve. And you can catch those Big Take stories, Bloomberg.com/Big Take, or go on the Bloomberg Terminal, NI space Big Take. Another good one today here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan, what I'm going to call an A-plus building. We're also streaming live on YouTube as well, so you can head over to YouTube and search Bloomberg Podcast. Talking about real estate on the commercial side, it is a hot topic for a lot of folks, particularly those in larger markets where you're really trying to figure out how this commercial real estate, particularly the office real estate market, is going to shake out here and what the impacts it'll have across the economy. We have an expert with us today. Ken Fisher joins us. He's a partner at Fisher Brothers. Joins us here in our Bloomberg Interactive Broker Studio. Ken, thanks so much for joining us here. Let's just start right here in New York City. Office real estate, what's your view?
Well, we're looking at a bifurcated market. There's the Class A trophy market, and there's just about everything else.
Okay.
What we've seen in our portfolio is a lot of activity. Tours are still fairly robust. And we've made some very, very big deals, some of the biggest deals in the country over the last year and a half.
Yeah, let's get to some of that. Just to give perspective to the listeners, Fisher Brothers has a core commercial portfolio in New York City, right? That includes 1345 Avenue of the Americas, 299 Park Avenue, and Park Avenue Plaza. Like, these are like big, huge centers that are really iconic in the financial industry. Talk to us about the kind of leases that you were signing, say, last year, and what kind of leases are you signing this year?
Well, that's been fairly consistent. The rents themselves have been fairly stagnant. They haven't moved much.
Okay.
What has moved is the net effective rents. The rents after you factor in tenant improvement allowances and brokerage commissions and free rent. That number has gotten hit substantially. The amount of landlord work has also increased. So as part of making the deal, there's tenant improvement allowance, there's also the work that the landlord has to do in terms of capital expenditures to make the buildings leasable.
So take, for example, at 1345 Avenue of the Americas, which those of us who have been here for more than 15 minutes call 6th Avenue, Paul Weiss, big New York City law firm, just took, I guess, 15-year, 143,000 square foot lease. So is that new space? Are they just kind of repositioning space? And what did you have to do? Did you have to put in pool tables and ping pong tables and all that kind of silliness?
I wish it was that simple, Paul. First, it was 765,000 square feet. We had a 1 million square foot vacancy facing us in 2025 with Alliance Bernstein moving out to Nashville.
Oh, that's right.
And so, before the pandemic, we actually looked inside the portfolio because we knew that we were competing now not only with our comp set, but also with new construction. We had seen millions and millions of square feet of new construction that we hadn't seen since the 60s.
Oh, wow.
And so we knew we had to invest and reposition the portfolio. And so we did so, and then, of course, the pandemic hit. And so in the middle of repositioning these assets with massive amenities like we see here in this building, we also had to modify our stance and start COVID-proofing the buildings. So we did HVAC work, a touchless experience, Bluetooth technology, all of that stuff that we hear about, we incorporated into our portfolio. And the result was, while again, we said that rents were fairly stable, it was the amount of work that it took to get Paul Weiss in.
Yep.
So it was not just what we saw in the deal itself, but what we had to do to reposition the building to get Paul Weiss to look at it.
So was that a healthy commercial real estate market? Is that an investment cycle? Like, how would you then describe it?
Well, again, we're looking at a bifurcated market. So, we're competing with other Class A assets. And so we, long before the pandemic hit, we just knew what we were going to have to do. There was a stat that came out years ago that almost 60% of the market was over 60 years or older. And so we fell into that concept. We fell into that grouping. And so it became very, very important for us to reinvest in the portfolio. And I think you'll see that those who have reinvested and spent the capital expenditures necessary to reposition their buildings have had some activity, and those who haven't have not.
One of my first Wall Street interviews was in Park Avenue Plaza, the old First Boston Corporation, back in the day. And I was like, oh, this is a real office.
Seems
This is
like
a real place.
lifetime.
Yes, it does. Yes, it does for many reasons. What percentage of New York City is A type of quality?
Gee, that's a tough statistic.
I mean, it's a 10, 20%. I mean, it's not 50%.
No, it's not 50%.
So it's less than that. So I'm just getting to the question. Bloomberg News, I referenced this article many times. A year and a half ago, 2 years ago, Bloomberg News wrote a story about 3rd Avenue, Times Square, to right where we are at Bloomberg's headquarters here at 58th Street. What do you do with that inventory? Because that's not A inventory for the most part.
No, it's not. If you look at the submarkets, you can kind of look at it from that perspective. Park Avenue, 6th Avenue, these are the hot markets. These are the hot places that a lot of deals are going because of the flight to quality that exists when market conditions take a little bit of a slump. What we've seen is we have a building at 605 3rd Avenue which straddles 2 submarkets.
Yep.
And so, look, it puts everything on the table. We've even examined the possibility of conversion to residential, which, again, takes a lot of resources to do. So that's something that we've discussed. I don't think it's going to be relevant to 605, but again, it's looking at the market in the form of submarkets and what is happening, and you can see the data, where most of these deals are happening are along those markets.
Sorry, go ahead, Paul.
Well, but I guess my question is, just pick a building out of thin air on 3rd Avenue, the Lipstick Building, because maybe some people who are out of town can think about that building. That's what we're talking about. If that were to trade hands today, 50% discount from pre-pandemic?
Just about, I would say.
Wow.
Pretty close.
That
40,
is amazing. That's, to
40%.
me, we haven't seen that market clear, have we?
No, I don't
But does
think
it
so.
have to?
It has
I mean,
to. 'Cause
is someone going to sell the building tomorrow?
The loans are coming up to be refinanced, and they have to do with a higher interest rate environment. So a lot of hands are going to be forced in the next couple of years, don't you think?
I think, yeah. I think you're more likely to see in a lot of cases, workouts where there'll be more equity required, to be invested back in. There'll be stricter covenants, more leasing reserves and reserves in general. I think you'll see that rather than the keys being handed back. And if it's a B or a C market, you might see residential conversions be discussed. I think, it's going to depend, in relation to that, it's going to depend a lot on when the loan matures as it relates to lease expirations.
Yep.
In terms of your reinvestment and the equity you have to put in, are you done in that cycle, or are you still putting in a bunch of cash to update all your stuff?
No, we have repositioned our portfolio. It's and I can still eat, so that's good.
He laughs at himself when he talks about it.
We have made a substantial reinvestment, and the results are that we have leased.
But that cycle's done for you.
For us, yes.
Yes. Okay. Do you feel like others are they also starting to do it now, or do you feel like for everyone that cycle is done?
No, I think it depends again on the asset and the submarket. You got to be very careful about the amount of money. You have to do it surgically. You can't invest the same amount of money that you would put into 1345, say it's 605 as an example. So I think there'll be some buildings yet to be repositioned, and there'll be some buildings that have gone through the cycle.
Would you, I don't know if you have a speculative part of your company that says, I'm going to go bid 30 cents on the dollar for this building on 3rd Avenue, because I think at that valuation, even if I have to put money into that building, I can make a good return. Are you guys thinking about that, or are you just kind of focusing on your core portfolio?
No, I think we have enough to focus on right now. We've actually developed over the last couple of years about 1,200 multifamily, with 300 yet to come down in Wynwood, Miami. We're developing that right now. I think as far as we are concerned, we also have a major immersive retail experiential development in Las Vegas. That's plenty for us right now.
Okay. Ken Fisher, for joining us. Really appreciate it. Ken Fisher, he's a partner at Fisher Brothers. For those of you who don't know it, I mean, particularly what I've learned about commercial real estate, it is oftentimes a family business, and there's a handful of New York real estate families, including the Fishers, but you think about the Dursts and the Tishmans and the Rudins and all that, and the Fishers are right there, and it's kind of a family business for a lot of these companies with substantial Wall Street support, of course, in terms of financing, but you go around New York City and other major markets and you see the same names time and time again in terms of it.
We're all in our 4th generation now.
Yeah, 4th generation.
So, just pretty impressive.
It's a family business. Great stuff. Ken Fisher, thank you very much.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.